The chapter "Raising Equity and Debt Globally" focuses on firms that need to tap liquid and unsegmented markets in order to attain the global cost and availability of capital. The textbook mentioned that firms resident in large and highly industrialized countries already have access to their own domestic market. For example, Walmart is a successful multinational firm that raised a lot of equity and debt around the world. Although Walmart has so many investments overseas, the company is still doing well in its own domestic market. Walmart is the largest grocery retailer in the US. Almost 62% of Walmart's sales came from its US operations. The term debt and equity get toasted around so casually that it's worth reviewing their meanings. Debt financing refers to money raised through some sort of loan, usually for a single purpose over a defined period of time. Equity financing can be a founder's money invested in the business or cash from angel investors, venture capital firms, or even a government backed community development agency. Equity typically becomes a source of long-term general use funds. The chapter begins with the design of a financial strategy to source both equity and debt globally. This requires management to agree upon a long-run financial objective and then choose among various alternative paths aided by an early appointment of an investment bank to get there. The textbook gives a perfect example to show how it works. From this exhibit, we could see that most firms raise their initial capital in their own domestic market. They are trying to skip all the intermediate steps to jump to the bottom line, a euro equity issue in global markets. This is the time when a good investment bank advisor will offer a reality check. On the other hand, we could also see that most firms that have only raised capital in their domestic market are not sufficiently well known to attract foreign investors. The chapter then analyzes the optimal financial structure for a multinational enterprise to minimize its cost of capital. Most theorists believe that the low point is actually a rather broad flat area encompassing a wide range of debt ratios from 30 to 60%. They also agree that at least in the United States, the range of that flat area and the location of a particular firm's debt ratio within that range are determined by such variables as the industry in which it competes, the uh, volatility of its sales and operating income, and the collateral value of its assets. The domestic theory of optimal financial structures needs to be modified by four more variables in order to accommodate the case of multinational enterprise. These variables are availability of capital, diversification of cash flow, foreign exchange risk, and expectation of international portfolio investors. Let's see the alternative path that a firm may follow in raising capital in global markets. Once a multinational firm has established its financial strategy and considered its desired and target capital structure, It then proceeds to raise capital outside of its domestic market for both debt and equity. For raising equity globally, you can choose IPO, a usual equity, or even a directed issue. For raising debt globally, the three major sources of debt funding on the international markets are international bank loans and syndicated credits, euro note market, and international bond market. In my conclusion, designing a capital sourcing strategy requires management to agree upon a long-run financial objective. If it is to support a new equity issue or to establish a market for share swaps, the target market should also be the listing market. On the other hand, if it is to increase the firm's commercial and political visibility or to compensate local management and employees, it should be in the markets in which the firm has significant operations. Additionally, a firm can lower its cost of capital and increasing its liquidity by selling its shares to foreign markets. Okay, thank you for listening. I hope you guys could enjoy my video. Thank you.